Welcome to Markets Now. I'm Michelle Rook with Craig Turner of StoneX, and a mostly higher day in grain and livestock futures trade, with the exception of some of the wheat contracts. A new contract, or new highs for the move anyways, in both corn and soybeans today. And Craig, how much of that was tied to putting risk premium in on South American weather?
It's dry in Argentina. It's been hot. The crop conditions, the ratings, they've been coming down. We are seeing a little bit of rain, and the temperature's getting a little bit cooler over the next week or so. But after that, it still looks hot and dry. So even the rain, the precipitation they get down there, it'll help, but it's not going to cure any of the stress and the drought that they have. Same for southern Brazil. So we got a old fashioned weather rally. What's going to be interesting here too is with soybeans, the lower soybean crop in Argentina could be helpful for the meal, and then certainly lower corn crop in Argentina would be beneficial for U.S. exports, which honestly, corn exports have been running above pace in the USDA and being part of the fuel, the fire here of the fund buying in corn.
Right. We did not get immediate tariffs from the Trump administration, still some possibly looming out there. But is there a belief in the market that we're going to get past this, that maybe we're even going to get a trade deal from China?
Yeah, that's interesting because we're about a week away from February 1st, and Trump is saying 25% tariffs with Mexico and Canada and 10% tariffs with China. And we're rallying in pretty big way. So at the moment, they're focused on supply and demand. We come next week and we get closer to February 1st and nothing's been done. I'm going to assume the market's going to pay a little bit more attention to these tariffs. Now, what ends up happening, with tariffs between Mexico and corn going to Mexico, and with China altogether. We'll see, but and we've also haven't seen any comments on soybean oil, or if Trump would tariff any used cooking oil coming into the United States. So there's still a ton of questions. The president, they say you got 100 days to get all your major priorities done. I don't know if the agricultural trade is going to be at the top of their really the top of their priorities in this first 100 days. So there's a whole lot of uncertainty right now.
No doubt. The funds have been adding to their length, though, in corn, and we're undoubtedly already long, maybe over 300,000 contracts, but they've gone long in the soybeans as well. How far will they extend their length in those markets?
Yeah. So for the corn market, what's interesting here is being at a 10% stock to usage in the corn market really is the line in the sand of being adequate to being a tight market. And once you get under 10% stock to usage and we're tight, the market really does have to start to price ration exports, and the funds know that. Now, if you have to price ration a couple of hundred million bushels, maybe you go to 550. If you have to price ration a billion bushels, all of a sudden we're going up to $7. So it really is a degree of how tight we're going to get and how much price rationing needs to have. The funds know that, so they'll keep on pressing their bets. And when you take a look at honestly, when you take a look at some of the options right now in the put market, you could be buying futures in March and buying a put right around the money for 10 cents, have a 10-cent risk in a situation in the corn market where, yeah, we may have enough corn and we never have to price ration, and you have a fixed risk, which is probably a reasonable risk for the reward. But if things get worse in South America, if demand picks up on the export market, whatever it may be for corn, you could get into a situation where you really have to start price rationing old crop to make sure you have enough of a carry out or the carry in for new crop. That is the function between old crop and new crop. So the funds, they can keep on piling in and drive it if they really think we're going to be going under 10% stock to usage and we're going to have to price ration our exports. Soybeans is a little bit different. There's still room there. And when you take a look at the soybean numbers, if South America, namely Brazil, has the amount of, it has a 165 or a 170 million metric ton beans, that's 15 to 20 million tons more than they had last year. That certainly can help. That's certainly going to eat into some of the U.S. export demand. So, beans, I think the way it was is, the funds are heavily short. Now they're long. They're probably moderately long. They're not nearly as bullish on beans are they on corn, and it's deserved. Just with, now we have not only do we have Argentine, weather problems, maybe you can have a little sneak up into Brazil. And I think the major wild card, though, why the funds may not be ready to just jump into beans, with both feet, is you just never know what's going to happen with Trump and China, how far those talks are along, if China will even want to, buy soybeans from the United States.
From a technical standpoint, you got soybeans above the 200-day moving average. You had some of the contracts in corn above the $5 mark. Where do we project to from a chart perspective?
Yeah, sure. So on the soybeans, great point there. We were above the 200-day on Tuesday, below it on Wednesday, closed above it on Thursday. We're gonna see, in the chart, you got $11 as a resistance level in the front months, and then you got 11.20, which which was the old support before we broke down. So, support becomes resistance, resistance becomes support on the charts. So you got that 11 and 11.20 on the beans. For the corn, it's more of a fundamental, range. Before COVID and the inflation in the economy of 15 or 20%, corn traded between about 350 and 420 most years, break below 350 on the harvest lows, and we would only go above 420 usually when we were at that 10% stock to usage ratio, and there was either threats to production or demand was just massive, right? And then all of a sudden we did have to price ration. You add on 15, 20% to that old range, you got a range in corn of like $4 to $5.20, where we really shouldn't go below 4 except for the harvest lows. And if we're going to go below 5.20, the market really has to believe we now have to start price rationing exports. We're not there yet. The USDA has us at a little bit above 1.5 billion, a little bit above 10% stock to usage. But if the market really believes that we're going to lose or maybe gain another 100, 200 million bushels in exports, or there's further decline in that Argentina crop, and honestly, Brazil, we're just getting started, right? With their second crop, which is a majority of corn, there will be weather premium. So if we get any weather issues in Brazil for the second half of their growing season, if things get worse in Argentina, we start seeing big export sales. If we go through that 520, like 525 area, that would be like going through that 420, 430 area of 5 years ago, from basically that period from 2007 to 2019. And at that point, you can, based on how projections are, it's hard to tell on the chart, how far you can go because now we're in price rationing mode. And once you get into price rationing mode, you can go up a lot faster on lower volume than you thought you could. So it's interesting what's happening with corn right now.
And Craig, we have the wheat market, which continues to lag behind corn and soybeans. We ended mixed there today. Corn and soybeans, seemingly would pull wheat along. But is the problem there that we have the higher dollar index, or is the market believe that we're going to see an end of the Black Sea war?
Yeah, so wheat's got a couple of headwinds with it. One, I think the funds are buying corn against wheat, right, to hedge out the dollar and systemic risk. I think you're probably seeing some wheat versus corn trading too. You know, on when you also take a look at the Ukraine war, there's probably going to be incentive now to end that. Not only does Trump want that to happen, but Putin, they've got high inflation rates. They just raised their interest rate to about 20%. What happens towards the end of wars is nations are spending so much money on military and they're printing money to pay for it because they're getting short on cash. You get inflationary pressures, plus the kind of rationing on materials that happen to the population. Whatever is available gets bid up with with the excess of money that the population has, like kind of like a rent control in World War II, here in the United States. So it's a good time for Russia and Ukraine and Trump to kind of just reset things. Everyone can save a little bit of face with the changing of the guard in the United States and kind of look at things again. And then if that's the case, and I think what the thinking is here is, now all of a sudden wheat is going to be available or easier to get into the trade routes, and there'll be more of it through the Black Sea. So there's a couple of headwinds for wheat. We did have that winter kill risk, but the demand hasn't really been there for the United States, and the Black Sea situation could be getting better. And finally, you mentioned the dollar. Yeah, wheat is by far the most sensitive to the dollar compared to any of the other major grain and oil seeds, because wheat is available on many more places around the world, actually for export in all four corners of the world. So very sensitive to the dollar.
And just a quick question about cattle, more all-time highs hit in live and feeder cattle futures here today, but it seems like that was tied to the announcement from APHIS that they are not going to reopen the border to Mexican feeder cattle imports. And so how much higher do you think we're going to have to go to price that in?
Yeah. So that was, yesterday we saw the market really rally in the front months. I mean, feeders were up 5, over, just in the front months over some of the summer months, which, they're up 2 or 3 points there. It was it was interesting. I think that, listen, the feeder market and cattle overall continues to get tighter. When you take a look at the cattle on feed and what's going on in the industry right now, I wouldn't be surprised if cattle on feed, we got tighter again in the industry in the second quarter. Prices, we're not keeping, the females in circulation. I mean, there's just too much profit in there, to do that. We're not seeing a whole lot of expansion in the livestock market. It's hard to, and honestly, it's harder for a younger person to get in, and the older guys
Right.
really don't want to. There's a lot of money going into to feeders here, so I just have a hard time seeing the supply expanding. And then what we're waiting for is for the demand, to weaken here at the high prices, and we're not seeing it that much. So for now, I mean, the trader's mindset is buy the dips, and I don't know, could feeders get to 300? Could live cattle get to 220? Are those the prices where you finally get so high the demand goes away and we crash? I don't know, but if you just take a look at technical analysis and you're drawing your trend lines on the chart and you're looking at Fibonacci and all these things, we got to, it almost feels like we need to make one more leg higher before we can seek some kind of demand destruction, because it's not happening at these levels.
Thanks so much, Craig Turner with StoneX. That is Markets Now.